Well, hello everyone, and welcome to this presentation. I'm actually going to be doing 3 presentations, and this is going to be part 1. And it's Master Yourself, Master Your Trades, Method and Mindset, and the Trading Process. I'm Leslie Jouflas, and I'm the founder of Trading Live Online. These are the other uh, presentations that I'll be doing, and these will all be tying together. I'd like to thank Synergy Traders and TradeOutLoud and Timing Research for inviting me to do these presentations. I do a lot of ongoing trader education. I have been in the markets for over 25 years. I'm a chartered market technician, and I've developed trading strategies and helped traders for almost the entire time. But we do have a limited amount of time today, so I'm going to get kind of right into our material so there's enough time to cover everything. But first of all, I think it's always important for everyone to first think out if trading is suitable for you. There's risk in trading, as we all know, and I hope that everybody has a trading plan that they work with. That certainly is going to help control your risk. And I want to mention that some of the slides that I'll present today are excerpt from my Trading Live Online course, Mastering Trading with Pattern Recognition. And some portions are excerpt from my book, Trade What You See, How to Profit from Pattern Recognition, that I wrote with Larry Pesavento. No part of this presentation can be copied or reproduced in any manner without my permission. Okay, with that, let's get going. So our focus today is going to be on this power trading setup called the AB equals CD. So why is this a power trade setup? Well, traders need something that's repetitive in the market, something that they can create an individualized trading plan around that's going to give them an edge in the markets. I have a lot of old books, old charting books, trading books from some of the old masters in my collection, some from the late 1800s, early 1900s, and all the way up to the present day. But when you go back and you study the charts, and you should if you study technical analysis, go back to the early 1900s, 1920s, 1950s, 2000s, et cetera, all the way up to where we are today, you will see that this pattern has been present on every chart that you're going to look at. This pattern is formed by investor emotions. It tends to form around turning points and retracement areas, and is very versatile in that it can be traded in ranges and trends. Now, traders there's not a one-all trade plan for this pattern. And again, I want to really emphasize that whatever traders decide that they want to trade, a method in a particular market, it's something that has to be studied so that you know it 100%. So I would encourage you to take time to study this pattern if you would like to do so, and then go on to create some type of a trading plan for it. Now, the other thing that's important about this particular pattern is that it is the root structure of other power trading setups, such as the Gartley pattern and the butterfly pattern, which on my blog at Trading Live Online, there's a butterfly tutorial video that I just put up a couple weeks ago. So feel free to hop over and take a look at that. So let's just move along now. The other thing that I want to stress with this presentation and other presentations is that your method and your mindset have to blend together no matter what it is you trade. So it's going to be really important for you as you develop a trading plan to also develop some type of a plan for your emotions and to have a way to assess how much your emotions are costing you. And this is something that I do help traders with. So feel free to reach out to me if you need some help. Okay, so let's start with a basic technical analysis pattern of this is an upward sloping parallel trend line channel. And the markets really just only do a couple of things, which in a way simplifies things for us. The markets go up, they go down, and they go sideways. They go into contracting phases and they go into an expansion phase. And they work in cycles and larger cycles all the way down to smaller cycles. And you'll see this occur repetitively on whatever time frame that you are trading. When the market's in this type of particular structure, we're going to see a lot of these A, B, C, D type of swings form. And they're testing highs, they're testing lows. When we get to the low point at support, investors step in and buy, it moves it up. And then at a B point, they're selling, we get a retracement and buying comes back in, and on it goes until it gets into an expansion phase, which I'll show you some charts of in just a few minutes. So let's now look at the basic structure of the ABCD. You can think of this as a lightning bolt shape. On the left side, you're seeing an AB equals CD buy pattern. On the right side, you're seeing an AB equals CD sell pattern. So we're going to get a little bit more in depth with the structure of this, but just remember this lightning bolt shape. This is the very basis of this pattern. So our lightning bolt, or ABCD, it's formed with three legs. The markets move in waves, and these waves repeat on a regular basis. And so that gives us a trading setup to be watching for. And this setup is going to repeat on, as I mentioned, all time frames and all markets. So we have the first leg that forms, the first swing down that's labeled A to B. And then the second leg, the B to C, that forms the retracement. Now the C point cannot go above or below the A point. And then once that retracement or correction is completed and the market starts to turn down in this particular example, then the trader can start monitoring for a completion area. So one of the very strong advantages to this pattern is that it can be recognized as a potential setup very early, long before it completes down at the D. So the trader has time to monitor the structure of the pattern, put it in context with where the market is, what type of environment the market might be in, a contraction or expansion phase, support, resistance, etc. We can also use Fibonacci ratios, which I'm going to show you in just a couple of minutes, to further define this structure. But I do want to mention that the AB leg and the CD leg, even though the pattern is called an AB equals CD, the CD leg can have variations to it. And that means that this leg can extend and be longer than that AB leg. And that is going to occur about 60% of the time. So it's well worth noting what you have to look for the extensions on this leg. So I use the Fibonacci extension ratio of 1.27 and 1.618. Those are the most common extensions. However, it will extend on very momentum type moves. It can extend to a 2.0 or even further. But generally, the 127 and 1618 are going to be the most common extensions. So let's take a look now at just an example of the Fibonacci retracements that I use in the Fibonacci extensions with our AB equals CD, our lightning bolt shape. So on the left side of the chart, we have the A to B leg, and that's followed by a B to C retracement leg. So this C point right here in this example on the left, if this is to be an ABCD pattern, this should not exceed that A point, the starting point of the pattern. If it does, then it is probably not an ABCD pattern. It may be another pattern that we can identify with technical analysis, but not an ABCD. So these are the Fibonacci ratios that I use for the retracement. There's the 0.382, 0.50, 0.618, 0.786, and 0.886. I just want to make note about this 0.886. This is what I call the last chance fib retracement. Many traders watch the 618 and the 786, and then the next point that they have is this 1.0. So a lot of traders, if price breaks the 786, they assume that that 1.0 is going to be broken. Well, I call this the last chance because many times the market will find, like in this case, a support at that 886 and turn from there. Here's a little tip with this. It's been over many, many years of working with this ratio. If the market has a close below or above an 886, then generally it will get to that 1.0 and very often exceed it. So there's a little tip for the last chance fib ratio, the 0.886. So these are what I have on my chart. Now the extension ratios, as I mentioned, there are 3 completion points that I monitor with this pattern. As I mentioned, we have the AB equals CD. So that would be our D 1.0. That's where AB and CD are equal lengths. So if you have 10 points here, you'll have about 10 points on your CD leg. The next ratio is the 1.27 Fibonacci extension. And all that is simply taking the length of the A to B, multiplying it by 1.27. You would add it to the low of C, and that gives you the extension. And you can do the same thing with the 1.618. Now on the buy patterns, we have the same thing. I've given you the example showing you the last chance fib retracement marked in here. And so you can get a deeper retracement. So again, as long as it doesn't exceed that A point, the starting point of the pattern, then you have a valid potential pattern. Once it starts to turn, you start to monitor for the completion areas. Now, if you're studying this, this pattern and you're going to your charts and you're looking for the pattern, you need to know how to label the pattern. When I started out learning this pattern, it's been a long time. I don't know. I can't even tell you how many patterns, but when I was learning this pattern, what I would do is I would do a combination of going to the charts and drawing them in, but I would just go and randomly print out different markets, different stocks, futures markets, different time frames. I would have just a stack of just blank charts with just the price swings on them. And then I would just simply take a pen and maybe a flat edge and just try and identify that lightning bolt shape without worrying too much about the fib ratios on it yet. The first step is going to be to identify that lightning bolt shape. But once you're ready to start adding the fib ratios, then you want to, I like to do it so the lightning bolt is bolded and then use a dashed line to mark in the retracement of the A, B, and C. So maybe a 618. Remember, we can, have that 886. Even if it retraces all the way to a 1.0, let me go back to this chart. So let's say that this retracement here got all the way. That would be a double, in technical analysis, also a double top. There's some things to be aware of with that, but technically it's still valid as long as it doesn't exceed that A point. The other ratio that you want to monitor with this is the B to C, and that's going to be a Fibonacci extension ratio, usually of 1.27 or 1.618. So again, it's very simple. You just take the length of your BC and you multiply it by 127 or 1.618. And in this example, you would subtract it from C and that would extend down. Now, these are helpful sometimes in trading because this ratio of the B to C can coincide with one of our extensions, either our 1.0, 127, or 1.618 are three different completion areas, and that can help the trader kind of pinpoint an entry into the trade. So it's kind of a good exercise to do this, to get familiar with it, and it'll give you a good feel for the pattern. So again, let's just go over, some of the basics. Once you've identified the lightning bolt shape and you have that correct shape, then you can start labeling the pattern A, B, C, D, and then check to make sure that these particular pattern structure requirements are in place. So we have the A to B, we have our retracement, and then the C to D leg has to get above B in order to find a potential completion point. And another thing to remember is that the sell patterns, notice how the sell patterns, the price is going to be rising on a sell pattern. It's not going to be declining. It's going to be rising. And on a buy pattern, the price is going to be declining. Okay. So we're going to look at some examples of these on a chart. I just took a screenshot of this morning. So the D completion point is always going to be below B or above B. So here's a little bit more of a detailed chart. This is again excerpt from my course on this. It's a full course, steps 1 to the end. It's 12 hours. Lots of fun listening to it. So here's just the steps that you can follow on here. You can use this as sort of a checklist if you like. And here's, drawings of our lightning bolt and the ratios and the correct labeling. And notice with the lightning bolt and the dashed lines, look how symmetrical. We have two triangles joined together. These are geometric shapes that repeat over and over and over. The markets do have harmony to them. And once you understand that harmony, then you can understand the repetitiveness and you'll understand these different phases of contraction and expansion. Okay, let's move on. Now that you've got an idea of the pattern structure and kind of how to find that, how to practice with that, I kind of told you how I did it. And you were welcome to do that. You're going to look at a lot of charts to be able to get good at this. But I mentioned the harmonics, and harmonics excuse me, are at work forming these patterns. We have swings up and we have swings down in the market, unless it's the crude oil market right now, which is just straight up. But most of the time we get swings in the market, and that's what forms these particular patterns. When you start studying the swings, and especially in the markets and the time frames that you trade, you can observe that there are repetitive swings happening all of the time. And there's also contractions and expansions of those repetitive swings. So in this example, we can see that the length of this swing up was about 34.25 points. This is off of a S&P 500 E-mini chart, but you'll find this on any chart. And then there was a corrective swing of 23.75 points down. And then the next swing to the upside was 35.75. So this swing was almost the same as this swing. And then next corrective swing was almost the same as that swing. So there's this repetitiveness that is happening all of the time. It's sort of part of those cycles in the market, price cycles. And so just, for fun, you might want to go into your charts and see if you can map some of these out. So here's another example. This is from a chart of Google, intraday chart, and I just marked in, the bigger swing that formed an ABCD buy pattern. These dashed lines are showing where an ABCD sell pattern was. So many times if there's a larger pattern forming in one direction, such as this larger ABCD buy pattern, on that retracement leg, there very often is an ABCD retracement that then points down to points you in the direction of that larger pattern, if that makes sense. So you might want to just study these charts that you're seeing today and see if you can, find some more, just sort of mark them in. Again, a lot of these little, swings here, like from this low to this high, it's almost the same length as this low to this high to this low, almost the same as this high to this low. And this goes on just all of the time. It's really a lot of fun to see once you spot it. So back to our parallel channel that we looked at in the beginning of this presentation. Again, using an example on the S&P 500 E-mini, which is what I trade quite frequently. I trade other markets too, but I most frequently trade the S&P 500. This is a very good market for these patterns. But if we start over here on the left side, we can see an A, B, C, D. This is a sell pattern. Remember, the market is rising and it forms an A, B, C, D sell. If you notice, this red arrow is just marking where a smaller A, B, C, D, all by itself in the CD leg, is sort of coming in and completing at the same area as our larger ABCD. So you can see multiple patterns within one larger leg. Many times that happens. It's quite frequent, actually. That can help the trader again, and I'll show you a chart of this in just a little bit. That having the multiple patterns in there can help the trader identify the potential areas for their trade. So the market was in kind of a contracting area here, and then it went into an expansion, and then back into a contraction of testing price up and down, forming this parallel channel. Well, within this channel, there's actually quite a few ABCDs. I didn't mark all of them in, but I just marked in a couple of examples just to show you this. So we have this ABCD here. See this lightning bolt, A, B, C, D. There's a buy. But over here, once the market found support, had a retracement up. Oh, there's actually an A, B, C, D right here too. I didn't mark that one in. So that A, B, and then you have your retracement leg with the ABCD buy pattern, and then that turns up and it forms this larger ABCD sell pattern here, and then down to the lower end of the trend line. And then we have another larger ABCD up here. I think you get the idea. Here's the ABCD down, another ABCD up. So there's a really good example of the repetitiveness of the swings in forming this particular, what I call power trade setup. Again, These can be, as I mentioned, they can form in a range, such as what we're seeing here. Parallel channel is really a form of a big range. Um, and they can also form in trends, which I'll show you a chart example of that as well. So again, you might want to just study this little, chart section and see if you can find more that I didn't mark in there. Okay, now let's move on. Symmetry is important with this pattern. It plays a role in the structure of this pattern and also in practical purposes of actually trading this pattern. And on the S&P chart that I grabbed a screenshot of this morning, I'll show you how that comes into play. But here on the left side is a symmetrical ABCD buy shape. There's our lightning bolt. Remember, the buy patterns are always descending. The center is an example of what would be a very asymmetrical. You have an AB slope, you have a retracement up, and then the CD leg is a very sharp. Notice how it diverges from the slope and angle of the AB. That's important. It's important to watch how the CD leg is starting to form. If it starts to form with just a straight down motion, there's probably some more momentum coming into the market, and this can be a warning sign for a trader. Another form of asymmetry with this pattern is when you have an A and a B, and then you have a very extended, whoops, wrong one, sorry, very extended B to C leg. Well, this is probably coiling, and coils are a form of contraction. And we know that when there's a contracting phase, an expansion phase is going to come out of that. So that means that many times if you have an extended B to C leg that looks like a coiling formation, it just goes on too long, then you may get a powerful move in that CD leg, and you probably see a steep CD leg. So when you're drawing in the patterns, make sure you're checking for the symmetry. The triangles that I showed you, that's what you'd like to see. It doesn't always mean when a pattern is asymmetrical that it's not tradable, but you have to have some skill and some expertise in this to know when you just pass on it and when you might be able to trade it. When you're starting out, it's probably best to just avoid it. So here's an example of a price chart with an extended long coil in the B to C leg. So you see how extended that is. Here's a little A, B, C, D buy pattern, got a retracement up, formed a A, B, C, D extension on the C to D leg, and then it just went on and on and on and on and on. And then finally, you can see this very long, wide range bar and a very steep decline. I would take that as a warning sign. So just to reiterate that, long, wide range bars, steep declines could be a warning sign. You want to look at the slope and angle of your A and B and determine if it's similar to the CD. It's not always going to be exact, but you don't want something that is very, very different like this is showing. So some chart examples of the symmetry. So if you're clone, now when I started this, I didn't have any drawing tools to draw these patterns in. I did them all with line drawings like this. And so you can do that. You don't need any fancy tools for this. So just if you think you see an AB, all you do is draw your line in, clone it. After you think your BC is complete, then you drop it in over here and you see how that clones the slope and angle of your A and B. You notice in this example, first, let me walk through this, A, B, C, D, A, B, C, D, A, B, C, D. So I hope you're getting the idea now of, how frequent these patterns can be. They're not all profitable trades, but again, your trade management is going to be key. These are just patterns. So the trader has to come up with the trade plan and trade management that they can apply to it that gives them an edge. But notice how the price is pulled away from what we cloned on the A to B. So notice how much space there is. Notice how that C to D leg is starting out to the upside with a very steep slope and angle, and it continues the steep slope and angle until it finally starts to find some resistance against that previous high there. So that's a good example, I think. Now, there's another form of symmetry as well, and that is time symmetry. And time symmetry is just basically looking at the number of bars in an A to B leg compared to a C to D leg. In this example, there are 9 bars down, approximately 9 bars down on the A to B, and then approximately 7 bars down on the C to D. So that's pretty close. You don't want to see something like 9 bars and 2 bars. That would give us, let me go back. That would give us something like this. So you had 9 bars, and now you have 2 bars that come down there and form that. So just a sec. There we go. Okay, so there's another way that you can sort of check and study the symmetry of the patterns. And another way is also, and this is complicated. I do not do this with every, setup that I do with this, but it's just sort of fun to do while you're learning. I think these sorts of exercises can really help to train your eye and understand this pattern, the ABCD, and then, as I mentioned, it's the root pattern to the Gartley pattern, which is a retracement pattern, and also a butterfly pattern, which is a reversal pattern. And when that particular pattern reverses, it is extremely powerful. I have a tutorial on the butterfly pattern. I think I may have mentioned that. So please, do watch that. So here's a relationship of the bar counts and Fibonacci ratios. So here's an example where the first leg has 13 bars and the second leg has 21 bars. Well, you think, oh, that might be kind of asymmetrical. Well, if we divide 21 divided by 13, that equals 1.615. That's, the golden ratio, 13 divided 21. And so sometimes you can find a Fibonacci relationship that way. In this particular example of the AB leg, the B to C retracement, there was also a second A, B, C, D here. And so again, that second, if there's multiple patterns forming in that C to D leg, in adding in these other tools that I'm giving you, that can really be a help again in learning this. Now let's talk about warning signs, because we've talked a little bit about them when we get that very steep asymmetrical, and that's something to be paying attention to. Or the other things that we want to look at are gaps especially in the C to D leg, forming right out of the C to D leg, and gaps that are close to the completion area. You don't really want to see a lot of those, because that's kind of just telling you that the momentum is strong in that direction to be able to cause that to happen on your price chart. So generally the warning signs in the C to D leg that you want to be aware of are gaps, long bars, and steep slope and angles. So an example here of the multiple patterns within the larger pattern can be a very strong tool. We're going to look at another example of this as well in just a couple of minutes. But here is a formation of the smaller patterns are in the lowercase and the large patterns in the uppercase. So the large pattern is A, B, C, and D, and the smaller patterns A, B, C, D in the A leg. Now, if a trader were to see this leg, you may very well be trading this A, B, C, D because you have no idea that this is going to happen over here. We don't have that luxury of having the right-hand side of the chart filled in. So is the name of the book that I wrote with Larry Pesavento is Trade What You See. So we would be seeing this and you would likely be trading that. You can see it got a retracement down and then turns back to the upside, and it completes at the 1.0 with additional A, B, C, D patterns completing in the same place. So now if we look at this with a little bit more structure, we can see that that was an upward, parallel trend line channel, just like what we looked at in the very beginning of this presentation, forming these patterns. So it's even though it's rising, it's in a contracting type of a phase. And then when it breaks these trend lines, then we see it drop into an expansion phase. So just a couple of examples showing you the completion points at the 1.0. So here's an example and how to find that. So if the AB leg is 10 points, then the C to D leg is going to be about 10 points as well. If the completion is around the 127, then again, you would take the leg of the AB, if it's 10 points, multiply that by 1.27, and then you add that to the bottom of your C to get the projection of where that 127 is. And you would do the reverse if it's a buy pattern, you would subtract it from C. If you want to find the 1618, then you can do that too, or do a few of those by hand. But most of you have charting software that have Fibonacci levels in it. And so you can put those extension ratios into that, and then you can just sort of draw it on there and do it that way. But I would encourage you to do some by hand. Now, this is what I was mentioning just a little bit earlier, is that multiple patterns within a larger ABCD can be very helpful to the trader in helping to determine where an entry point might be in a trade setup. Now, this particular example is showing where a potential, because they're only potential until they complete, A, B, C, D. So we have this larger pattern, this line right here. That is where the 1.0, meaning A, B, and C, D are equal, would have been, very close to a previous little resistance area there. You can see it didn't get there, but we can also see here's another A, B, C, and D in this area, and then another A, B, C, D formed here. So there's 3 different patterns. And sometimes when you get really good at this and you've had a lot of practice with it, you can find an entry based on something like this. And as long as your risk is, your risk is in check, you never want to exceed your risk, then that might help you find an entry point that's not quite at the larger pattern. It still you may enter on something like this, a little bit shy of that. So you have to be prepared for the market may, come up and trade to that as well. That's just part of trading. But you can see in this example, I hope, how useful it might be to be identifying those multiple patterns. So just to show you that This is repetitive in all markets. Again, this is a chart that you can study. There's many more ABCD swings in here that I didn't draw in, but here the market's in a sideways range, which is a form of contraction. And you can see, many A, B, C, D. There's A, B, C, D buy pattern. This reached up to a 618 retracement from high to low here. Not every A, B, C, D buy pattern is going to complete and then just move up to a new high. Sometimes they'll get a retracement up. Sometimes they'll get a small retracement, a deep retracement. Sometimes they'll get no retracement and they just keep going, and that's going to be a stop out. So you've got to study these patterns and see what do they do in order to formulate a trading plan that you might be able to work with. Over on the left side here, just A, B, C, D sell pattern, and we can see this one extended nicely to the 127 and then came down. It did a 618 retracement, taking the low to the high, 618. When I'm doing my retracements with these patterns, I will use both the retracement from the C to D and also the retracement of the full pattern from the A to the D. And I'll be looking for kind of some confluence in those areas. Now, conversely to what we just looked at, where the euro was in a sideways range, this is a chart of the euro and with ABCD patterns in an uptrend. So you can see the market here started an uptrend. Notice these bars, notice the steep slope and angle on these CD bars. We talked about that as a potential warning sign. I know I'm not showing you anything to the left here. So maybe the market is coming out of a contraction area and now just going into the expansion phase. But you can see that with this extended move to the upside, now it forms a corrective ABCD pattern on here. And then the trend continues to the upside, makes new highs, and forms another ABCD buy pattern, extends down to the 127, and takes a little bit of time to jiggle around, and it continues the uptrend. So there's different market environments. But again, you can just break it down into they go up, they go down, and they go sideways. Contraction and expansion. And here's an example of ABCD pattern in a trend. This is actually on an intraday chart from the S&P 500. And so the ABCD pattern can also be part of classic technical analysis, such as a bull flag. So many bull flags will have a ABCD, and those can help the trader identify an entry point. And you'll see, these little corrective, swings here, even in this little sideways range, ABCD. Trend continues up. This is dynamite triangle. That's actually from H.M. Gartley's work from 1935, Profits in the Stock Market. But we don't have time to go into that, but it's a powerful little pattern as well. So I've marked in all these little ABCDs that occurred, in this uptrend here so that you can see that example. Okay, now let's take a look. Here's actually, I have the other chart of this. I want to show. It's the same chart, but it's the next one. I updated it again, so let me wait and get to that. Now, I've mentioned a couple times in this presentation that you have to find your method and your mindset, what works for you. I help traders do that. And again, please reach out if you want some help with that, but it's really important for you to find what is going to work for you. And that takes some time. That's a process in and of itself. But this chart is just an example. I have, so a hypothetical trader number 1, trader number 2, and trader number 3. And so we can see that maybe trader number 1, maybe they do these patterns for just a small retracement down and they're out. And then maybe trader number 2, maybe he's a little bit fearful and gets into the pattern and moves a stop loss too close too soon. So they're stopped out without any profit. Maybe trader number 3 has taken time to develop a trading plan and really understands these patterns and is able to navigate the pattern so that they're doing multiple exits. And now there is a trader number 4, but they never got in the trade because they were too afraid to pull the trigger. So again, method and mindset. If you know those are things that are getting in your way, then something is out of sync with your method and mindset. It probably starts with the trade plan or maybe lack of a trade plan. Okay, so let's go to the S&P chart from this morning, and I didn't update it, you know, to where we are right now, but I just wanted to show you some examples of some ABCD patterns. And this is from early this morning here. So we're just going back, I think just a couple of days on this chart, but this is the intraday chart with AB equals CD patterns. So notice how this pattern, this little ABCD cell pattern comes up here. And notice here, this gets a nice little retracement. This is actually about a 20 something point move. We have a lot of volatility in the market right now. So, you know, one bar on the S&P can easily be 20, 30 points or more. So this for like if we have trader 1, 2, 3, and 4 again, you know, this can be a profitable trade for a trader. And then the market continues to the upside from there. It forms a ABCD buy pattern, extends down to the 127, kind of flutters around, finds some support, and then finally has a larger move. Well, depending on how you as a trader trade this, again, you might be here taking a, you know, 3-2 retracement, or maybe you're doing it on number of points or something else. Maybe another trader is maybe doing more of a swing trading and holding for longer, maybe using a wider stop, and they sit through all of this up and down, up and down, up and down, then they catch a bit of a larger move. Again, here's an example ABCD cell pattern, and look at, you know, here's our long wide range bar, but here we have a doji now, so we can combine candlesticks with this and finds resistance at the 127 and gets a retracement down and then continues the leg to the upside. This morning, we had an ABCD buy pattern, but look at this. That's a pretty long bar. It's a long bar. It's longer than any bar in this entire pattern. So this is telling you that it's likely to continue down. Now, how far down? You don't know. You know that there might be, from looking at this chart, this is just a small section, might be some support in here, but still, the second bar is a long bar down too. And then it reverses up with a candle, and that's not going to be a good risk reward. Yeah, that's a big stop right there, and it's already done, you know, some retracement up. So maybe that's one that's there, but it's not really all that tradable. And then here, there's another A, B, C, D down here, kind of retesting support. But look at all this mess in here. So you really do need to be willing to take the time to study these patterns. And in the markets and the time frames that you trade, watch these patterns on those time frames, find where those harmonic swings are, and incorporate those into what you're doing. Those are going to help you to determine, you know, maybe entry points, stop loss placement, and help you with the exit strategy. And I can also help you with that. Okay, so that is the presentation for the power trading setup, the AB equals CD. And I just want to present to you a special. I do have a course. This is sort of an introduction course, but it's quite lengthy and quite extensive on the structure of not only the ABCD, but also the Gartley and the butterfly reversal pattern, and also another pattern called the 3-drive pattern, which is not talked about that much in trading or in technical analysis, but it's a great little pattern to know, and it does contain the ABCD. So generally on my website, it's $99 for this introduction course. someone who just emailed me a couple days ago. This is what they told me about the course, and I could not agree with Mr. Billings more on that. But I'm also going to add in to help you learn. There's a lot of other materials. There's lots of videos that go along with this and articles. It's quite extensive. But I'll also give you a 1-month free subscription to my weekly market setups. And this is where we do every week. I'm going to, in fact, do it right after we get off this presentation. This is our preparation for next week's trading. So I'm going to go in, I'm going to look at the charts, we're going to look at patterns, we're going to look at potential setup areas, and we're going to do a lot of work so we're prepared for our next week's trading. So you'll receive a month of that with this course, and also a copy of my other book, Essentials of Trading. It's not what you think, it's how you think, and that hopefully will help you in the mindset portion of your trading. So you're going to have a 1-year access to these course videos, and 1-year access to articles, dozens of articles, and a year access to the trade lesson videos. And I'm going to be taking off some of those videos. There's a lot, but right now there's about 100. So if you sign up now, you'll still get access to all of them. So just type this URL in, and that will bring you to the page. Thank you for joining me today. Here's my website. If you have questions, here's my email. And best wishes for successful trading. This is Leslie Jouflas with Trading Live Online.